the tax-free municipal bond tax trap, and why you should be careful of deeply discounted munis. Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our Base and Boost mini-series, where we'll be talking about municipal bonds, and a not very often discussed topic that can come as a surprise to new muni investors. So, with that in mind, here are the three topics that we'll be covering today. 1. Where do municipal bonds fall within our base and boost strategy? 2. When might tax-free munis not be tax-free? And 3. How does the de minimis rule work in detail? Let's dive in now, folks. Where do municipal bonds fall within our base and boost strategy? Let's first quickly recap our Diamond NestEgg base and boost strategy for retirement. Please check out part 1 of our base and boost strategy video, link below, if you need more details at any point. So, here are the two key components to our Diamond NestEgg base and boost strategy. The base part, this locks in the required income to cover your everyday essential living expenses in retirement. What you need to keep a roof over your head, the lights on at home, and food on the table, so to speak. In our mind, the base part of the strategy should mainly be oriented towards safe, stable, and predictable income that lasts a lifetime. No experiments or unnecessary risk-taking here with the base. For an investor who is in the highest tax brackets and able to find non-callable munis that fit his or her time horizon, we could see the highest rated municipal bonds as part of a bond or annuity ladder in the base part of the portfolio. The boost part, this should protect you against inflation, help build generational wealth, and or be a source for discretionary spending, whether it's that special night out in town or a big vacation or perhaps a new car for your grandchild or another loved one. The boost part is where you may want to take some controlled risk for possibly higher returns and income, but it may fluctuate over time, so you would not necessarily rely on it for your everyday essential expenses like you would for the base part of the portfolio. Higher yielding municipal bonds, which also generally means lower rated municipal bonds, whether callable or not, may be more suited for the boost part of the portfolio. Again, assuming that it fits your personal situation. When implemented properly, our Diamond NestEgg base and boost strategy may help you in building out your sleep well at night portfolio, just as we expect it to do for us at some point in our later years, because you know you'll have enough income to cover your day-to-day basic living expenses for as long as you live. And at the same time, you may still be able to invest in some higher yielding assets in the boost part of your portfolio. And if you're interested in joining a high quality, private community of like-minded folks and learning more about how everyone is building out their base and boosting the rest of their portfolio, come on over and join the growing member community in our VIP investment club, where these conversations are happening practically every day. Our spring sale is on. Use coupon code INCOME2026 at checkout to get $100 off of our private VIP investment club membership before Sunday, May 17th. There's one more week left to save and just in time to join this month's Member Live. Visit our website at www.diamondnestegg.com and click on this yellow private VIP investment club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for a popular bond course bundle. Please keep in mind that Diamond NestEgg is not a tax advisor. Always consult with your trusted tax advisor on your personal situation. So, now that you have a good overview of the two key components to our Diamond NestEgg base and boost strategy, let's move on to the next part of today's discussion to make sure that you understand a topic that may sometimes trip up new muni investors. When might tax-free munis not be tax-free? So, as many in our fixed income community already know, one of the key reasons for investing in municipal bonds is that interest income earned on many, but not all, types of munis is tax-free, both on a federal level and even on state and local levels, assuming you're buying in-state munis in your state of residence. However, these tax exemptions may not apply to gains made from trading a muni on the secondary market. Any trading gains on munis are in principle taxable as capital gains. Now, as many of us are aware, Capital gains may be taxed at lower rates than interest or income, making the sting from the taxman potentially a bit less painful. But there's another tax feature out there that applies to munis, and it can be quite important: the de minimis rule. To understand the de minimis rule and how it applies to munis, let's do a quick recap of some basic principles first. As our Diamond NestEgg regulars already know, both T-bills and Treasury zeros don't pay regular coupons. Instead, you get your interest when the bond matures and your principal payout is larger than your initial purchase price. And because this difference between your purchase price and the principal payment at maturity is essentially your interest payment, this difference is taxed like interest at your full marginal income tax rate and not at the lower capital gains rates. The same principle applies if you buy a bond at a discount on the secondary market. If you hold such a bond to maturity, then the difference between your purchase price and the principal repayment at maturity will again be treated like interest income and taxed at your full marginal income tax rate. It's straightforward enough up to this point, even if it's not what investors would have wished for. At least we can understand where this comes from. The taxman wants to treat all guaranteed income earned from a bond the same because it's essentially interest, regardless of whether it gets paid out as a regular coupon over the life of a bond or as a one-off at maturity. Now, the detailed rules about the taxation of discounts can be complex. For example, a discount that you get when you buy a new bond at issuance, what's often referred to as the original issue discount, or OID, may have to be accrued yearly as so-called phantom income, while a discount that you get on the secondary market may only be taxed at maturity. And because the rules on discounts are complex, the de minimis rule tries to make it a bit easier for bondholders and basically says that a very small discount at purchase, a de minimis discount, may be taxed as a potentially privileged capital gain and not at the usually higher full marginal income tax rates. So far, so good. The principle is that discounts at purchase are treated like interest, such as for T-bills or zero coupon bonds, but very small discounts don't trigger full taxation. But what does this have to do with munis? First, the easy part. So, in keeping with the principle that discounts are treated like interest, any discount that you get when you buy a new tax-free muni when it's first issued should be tax-free, like any other interest on a tax-free muni would be. Now comes the snag, though. The IRS says that only a discount that you get when a muni is first issued, what they call an original issue discount, or OID, may be collected tax-free at maturity. However, when you get a discount from buying a muni on the secondary market, so any time after it's first issued, and not from the issuer directly but from someone else, this discount may be taxed. And this unexpected hit from the taxman on munis comes from the way the de minimis rule was written when it was introduced. Either they weren't thinking about munis or they didn't like them too much. In any case, what happened is that the de minimis rule, for all practical purposes, may take the tax exemption away from munis for interest-like income that is earned from a discount on the secondary market. Remember, this only applies to discounts on the secondary market. But if you see a deeply discounted muni on the secondary market and may be tempted to snap it up on the cheap, so to speak, be aware that you may be taxed. First, a very small discount, a de minimis discount from buying a muni on the secondary market may be subject to capital gains tax. And second, if you buy a muni on the secondary market at a larger discount, the entire gain may be subject to the full income tax rates. And this, by the way, is one of the reasons why many issuers try to make sure that their munis trade generally at par or above and not at a discount. We'll talk a bit more about this later. And if at this point you want to see how other members and super savers like yourself may be building out their portfolio in a trusted private setting, and not just with municipal bonds, but with other safe, stable, and predictable income sources in the base part of their portfolio, as well as higher yielding assets in the boost part of their portfolio, don't forget to take advantage of our spring sale. Use coupon code INCOME2026 at checkout to get $100 off our private VIP Investment Club membership before Sunday, May 17th. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for a popular bond course bundle. And let's move on now to the next part of today's discussion. How does the de minimis rule work in detail? So let's walk through how the de minimis rule works in detail for munis. As I just mentioned, de minimis tax applies to munis purchased below a certain discounted price. And keep in mind, it has to do with the purchase price of the muni on the secondary market only, and not for munis issued at a discount initially, as we just went through. The de minimis rule also does not apply to the regular interest payments from a muni, which should not be affected and may remain tax-free. So any gains you may have from a muni that you purchase below par value on the secondary market and hold to maturity will usually be taxable. And according to the de minimis rule, for bonds purchased at a discount of more than 0.25% for each full year from the time of purchase to maturity, the gains resulting from the discount may be taxed as ordinary income rather than capital gains. What did I just say, right? Put simply, this is the consequence of the de minimis rule that we just discussed. If the secondary market discount on a muni exceeds a certain threshold, an investor may have to pay ordinary income tax on any capital gains, rather than capital gains tax. And generally speaking, the ordinary income tax rate may be higher than the long-term capital gains rate. As I said, not necessarily an investor-friendly arrangement, and not what you'd be expecting in overall tax-friendly muni land. Here's the formula for the de minimis tax rule. The de minimis threshold is equal to the bond's par value minus the combined total of the par value times 25 basis points times the bond's years to maturity. The numbers that need to be inputted are here, here, and here. This 25 basis points does not change because it's explicitly stated as part of the de minimis tax rule. So let's assume that we have a muni with a par value of $10,000 with 10 years to maturity. This means that we take $10,000, the par value, minus the combined total of $10,000 times 25 basis points times 10, the full years to maturity, which gives us a de minimis threshold of $9,750. Now, let's move these numbers up here for easy reference and see what the tax implications are under the de minimis rule for 3 different scenarios. This column shows the purchase price range of the muni, and this column shows the tax implications under the de minimis rule based on the purchase price ranges here. Scenario 1. The investor purchases the muni below the de minimis threshold of $9,750. This means the entire difference between the par value of $10,000 and the purchase price might be subject to ordinary income tax. Scenario 2. The investor purchases the muni between the de minimis threshold of $9,750 and the par value of $10,000. This means the entire difference between the par value of $10,000 and the purchase price might be subject to capital gains tax, which, as we remember, might usually be lower than ordinary income tax if it's for long-term capital gains. Scenario 3. The investor purchases the muni above the par value of $10,000 at a premium, basically. In this instance, neither ordinary income tax nor capital gains tax would apply, as there is no gain. Now, as we said before, issuers often sell new munis at a premium initially, sometimes a substantial premium, as you can see here, for example, to reduce the likelihood of them trading at a discount in the market later, exactly to avoid the potential tax consequences of the de minimis rule on the secondary market later. But it doesn't always work out as planned, especially when rates go up a lot. So when you see a muni on the secondary market with a price that's significantly below par, such as these deeply discounted low coupon AAA and AA muni bonds from New York, that show yields to worst of up to 4.956% at the time of this taping. Remember that the gains you make from the discounts on a purchase may be subject to your full marginal income tax rate according to the de minimis tax rule. And as always, at this point, I'd love to invite you to join the growing community in our VIP investment club, where our members have regular conversations about their financial and retirement journeys, trade investing ideas, and help one another whenever and however they can. Use coupon code INCOME2026 at checkout to get $100 off of our private VIP investment club membership before Sunday, May 17th. There's one more week left to save and just in time to join this month's Member Live. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for a popular bond course bundle. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.